We'll be going over IRS Schedule D, capital gains and losses. So when taxpayers either sell or otherwise dispose of certain assets, they must report the sales information, specifically how much the item cost, how much they received when they sold it, and then reporting the gain or loss. And depending on the treatment of those gains or losses, you could either increase your taxable income or you could reduce your taxable income. So Schedule D covers a lot of different transactions, but specifically transactions, primarily transactions where you had something of value and you either sold it or you otherwise disposed of it. And we'll get into the details of all of those nuances as we go through this schedule. So just be aware that there are lots of nuances that we won't be able to cover in this video. The accompanying article that we've written also covers a lot of details, but there are also several IRS publications and specifically the form instructions that will go really deep into certain things like short sales or how to declare the exclusion of gain on qualified small business stock. Very specific, nuanced details we'll probably not be able to cover either in this video or in the article. So we've tried to curate some of the more common items that taxpayers would see, specifically when they receive their IRS Form 1099s in the mail, or if they receive certain partnership, K1s, things of that nature. So as we go through this form, we'll kind of walk through how capital gains and losses are netted together, and then how that information flows into your tax return. So if there are questions that are very specific, please hit me up in the comments section. I have no problem creating a separate video to go into a little bit more detail on a very nuanced item. But in other words, if you don't see what you wish to in this video, hit us up in the comments section. You may need to file other forms when you file Schedule D. So if you had involuntary conversions, for example, of property, either because of a casualty like a natural disaster, or if something was stolen, then you would report that on IRS Form 4684. If you had installment sale, you might need to declare the installment sale income on a separate tax form. If you are subject to the net investment income tax, then you may need to file IRS Form 8960. So we do have references to articles that we've specifically written on those tax forms throughout our articles, and we'll have links to those articles in the show notes as well. So the first question we should probably ask is, what is a capital asset? Because this tax form is for capital assets. And the IRS has 9 different types of property that could be considered not a capital asset. And then most everything else that you use for either personal purposes or net or investment, that would be a capital asset. So technically your house would be a capital asset because you can buy it at a price and then you can sell it and make a profit on it later on. So the 9 things that are not considered capital assets would be stock and trade or inventory. If you own a business, a retail business, your inventory would not be considered a capital asset. Notes receivable or accounts receivable, depreciable property that you use in your trade or business. Real estate used in your trade or business is technically not a capital asset. Patents, inventions, models or designs, things of that nature, copyrights, those intellectual property that fits one of those descriptions generally is not a capital asset. U.S. government publications, certain commodities like derivative instruments. So that's a very nuanced part of the tax code. Certain hedging transactions in the normal course of trader business, and then supplies that you use in your trader business. Most everything else the IRS considers to be a capital asset. So as we go through the schedule, you'll see that there are three parts. There's part one, which is short-term capital gains and losses. Part two is long-term capital gains and losses. And then in part three, we'll go over the summary so that we can kind of walk through where you would report certain items. So there are references to several worksheets when we get to the summary section. Some of those are in our article, and some of those we have links to the specific area, either in the Form 1040 instructions or in the Schedule D instructions, simply because of how long these worksheets are. So we'll make sure that there are links to all of those different areas, either in the show notes or in the article. So let's go through Schedule D as if we're in the shoes of our hero, John Doe. So at the very top, we have his name as shown on his income tax return, followed by a social security number. And then the first question that is asked is, did you dispose of any investments in a qualified opportunity fund during the tax year? Qualified opportunity fund basically warrants special tax consideration. So you can make an election to, if you had an eligible gain, you can then reinvest that money into a qualified opportunity fund, which is usually organized as a corporation or a partnership that invests in certain property located in a qualified opportunity zone. So, urban development, that kind of thing. So if you have an eligible gain, you can invest it in the QOF, the Qualified Opportunity Fund, and then you can defer part or all of that gain until at least December 31st of 2026, or the date in which you exchange or sell it. So if you did sell it or exchange it, then you would need to attach a completed Form 8949 and then select yes here. So our hero John Doe did not do that, so we're going to select no. So in part one, we have short-term capital gains and losses on assets generally held for a year or less. So before we get into the detail of part one and then part two, which is very similar, the difference between short-term capital gains and losses and long-term capital gains and losses. So the IRS considers short-term, the holding period is 1 year or less. So a lot of questions happen to be, if I held an investment exactly a year, would it be short-term or long-term? And the answer is short-term. Now, if you held it for 366 days, 1 year plus 1 day, then you would report it as a long-term capital gain or loss. So the difference is short-term capital gains and losses get added to ordinary income. So they're subject to ordinary taxation at your ordinary tax rate. So if you were in the 24% tax bracket and you had a $1,000 capital gain, you would expect to pay 24% on that additional income. However, long-term capital gains have what's known as preferential tax treatment. So that tax treatment ranges from 0 to 20% at the maximum, depending on your marginal tax bracket. So a taxpayer at the 24% tax bracket would actually only pay 15% in capital gains on that same transaction if the holding period was 1 year plus a day or more. So that's the difference between short-term and long-term capital gains treatment. Now what we'll do is we'll calculate the short-term gains and losses in part one. We'll calculate long-term gains and losses in part two. And then in part three, we will work through the schedule so that we can figure out exactly how to report this information, and then if there are additional worksheets that are required. So at the top of this form, we've got in line 1A, this is the totals for which short-term transactions were reported on your 1099, where the basis of that investment was reported to the IRS, and you don't have any adjustments. So, for example, if you had a Schwab account and you bought and sold investments that were recorded by Schwab, Schwab, as the custodian, has records of all that information. They can report that to the IRS. You would receive a 1099. If you saw a basis in your 1099, then you would report it as here. Now, some taxpayers, either because they can or because they need to in certain circumstances, might file what's known as IRS Form 8949. So if you do, then that's you would enter those transactions on lines 1B, 2, and 3. And we'll get to that momentarily. But line 1A is reserved for transactions where the transaction was not reported on IRS Form 8949. And so we've got this transaction right here for line 1B. We didn't put, this is, so, IRS Form 8949 is for the sales and other dispositions of capital assets, and you have short-term, and then on the back you have long-term transactions. So this kind of goes hand in hand with Schedule D. In line 1A, you're only considering transactions that were not reported on 8949. So in this case, John Doe sells $10,000 of stock. It cost him $5,000, so he's reporting a $5,000 gain. Now on line 1B, we're basically going to report any transactions on IRS Form 8949 with box A checked. So we'll go back here. You'll notice that on this form, he checked box A. Box A indicates short-term transactions that were reported on your 1099. Basis was reported to the IRS. So you reported it here. Now, there's a note that says you can aggregate all short-term transactions where the basis was reported, no adjustments. You can enter that directly on line 1A, and you don't have to report that here. So the distinction is there are some transactions you have to report on IRS Form 8949, but the ones where you have a choice of reporting on 8949 and then transferring it over to your Schedule D, that impacts which box or which line you report in Section D or Schedule D. So for example, this is a completely different transaction from the one that's in line 1B. The line 1B happens to be John Doe's disposition of Acme Business Holdings. He held it for 3 months. He sold it for $10,000. He bought it for $5,000. So this gain or loss is right here. And that's what he's reporting here. To make things easier for you, I'll just say that this is a different transaction that he sold for $12,000 and his cost basis was $5,000. So let's adjust that. So 2 different transactions. One was reported directly on Schedule D. The other one was reported on Schedule or Form 8949 with box A checked. So the same thing would happen with lines 2, with lines 3, but let's go back to 8949, where you would have to have a completely separate Form 8949 to document the box B transactions, basically transactions where basis was not reported to the IRS. And then box C would be short-term transactions that were not reported to you at all on a 1099-B. So these are different types of transactions because the box B transactions, you may have to have records that show the basis, or you might have to construct it on your own because the basis was not reported on the 1099-B. And then in Schedule C, you're going to have to have even more documentation because now you don't have the proceeds on 1099-B and you don't have the basis. So you're going to need to make sure that you have records indicating your proceeds and what your cost or other basis would be. So each of those will get reported in a different line. For convenience purposes, I left those blank, but let's go ahead and just put in some information here. Now let's imagine that I had a 1099 that reported proceeds and my basis, but the basis was incorrect. And I have records to show that this would actually need to be a $6,000 cost. So what I would need to do is indicate in column G on line 2 my adjustments. So you would have to enter a code that says why I'm making this adjustment. You would enter the amount of adjustment here. Let's just call that $4,000 or $1,000 adjustment. So now my taxable gain or loss is actually $4,000. This would actually go in here. And then it gets reported up here as a $1,000 adjustment. Okay, so that's how you would enter adjustments for these transactions. Now in line 4, we're going to enter gains or losses from other tax forms or schedules that you might have had to complete. So specifically for line 4, we're talking about IRS Form 6252, which reports installment sale income, IRS Form 4684, that reports casualties and theft losses, and depending on the basis of your assets as reported, from your insurance claim or your reported casualty, you may be reporting a gain in certain circumstances. Section 1256 contracts and schedules are reported on IRS Form 6781. And finally, like-kind exchanges are reported on IRS Form 8824. So obviously you'll be filing each of those forms as applicable with your income tax return, but this is where you would net all of that together and report it in line 4. So let's just say you had $10,000 total. Now on line 5, we're going to report any Schedule K1 gains or losses. So if you're a partnership, S corporation, estate, or a trust, you would enter the amount of your net short-term gain or loss. So let's just say that it's a $5,000 loss. And then if you had any capital loss carryovers, which you would find in the capital loss carryover worksheet, you can find that in the IRS form instructions. That's also in the article, so you can find that in either place. So in order to calculate your capital loss carryover, you'll use the capital loss carryover worksheet. It's the same form that you would use for either short-term or long-term capital gains and losses. So in essence, if you had a capital loss that was disallowed in a previous year because you're only allowed to deduct up to $3,000 of a capital loss against ordinary income, you may have to carry forward the rest of the capital loss and just work it down against capital gains, against ordinary income. So you would carry that forward here, and we're going to enter, let's just call it a $5,000 capital loss carryover. So now we're going to net all of these short-term capital gains or losses. So we've got minus $10,000 here, we've got plus $10,000 here, and then we've got, it looks like 10, 15, 8, 12, $19,000. So we have a $19,000 capital gain. We're going to sit tight on this. If we did not have long-term capital gains, we would simply go straight to part 3. But let's just imagine that our hero, John Doe, also entered into some capital gains transactions, long-term transactions. So let's just say they had $10,000. That was reported to him that he decided to report directly onto Form or Schedule D. So $10,000 long-term capital gain. Let's say that he had a loss that he reported on Form 8949. And again, Box D is going to be the same on Form 8949 as Box A was for short term. So long-term transactions reported on a 1099 that shows basis being reported to the IRS. And then Box E would be for transactions reported on a 1099 where the basis was not reported. And then Box F would be long-term transactions that weren't reported to you at all on a 1099. So again, the increase in the amount of paperwork you would need to have to either reconstruct your basis or to document the transaction. You're going to need that. So in this case, we're reporting a loss of $10,000. And then we'll just assume that for this example, we didn't have any transactions where we needed to check Box E or Box F. So we're going to net this amount, the amount of the capital gain or loss here, but we're also going to go to line 11 where we're entering gains from several different forms. So basically we're talking about the overall gain of from IRS Form 4797, which is the sale of business property. You would also be reporting any undistributed long-term capital gains that were reported to you on IRS Form 2439. Any installment sales on IRS Form 6252. Any gains or losses from casualties and thefts, Section 1256 contracts and straddles, and like-kind exchanges. So all of those transactions, a few more than under the short-term section, but a few more. Let's just imagine that we had a net loss of $5,000 from all of these transactions. And then we reported $5,000 of income on partnership from a long-term gain from a partnership. And then we also had capital gain distributions. So capital gain distributions are from net realized long-term capital gains paid out by a mutual fund or another regulated investment company or a real estate investment trust known as a REIT. So only long-term capital gains are paid as capital gain distributions. Short-term capital gains are actually included on your Form 1099 DIV as a ordinary dividend. So you would never actually report that in the long-term gains section. So the important thing to realize is that you would report your capital gains distributions as under the long-term section based on the fact that the mutual fund or the REIT had that investment for 1 year plus 1 day or long-term tax treatment. But you could have bought that mutual fund and held it for 3 months, and you would still get the same long-term capital gain treatment because the underlying asset is subject to capital gains tax treatment and not ordinary income treatment. Now, if you sell that mutual fund, then the gain or loss that that you incur on that mutual fund can be short term or long term. But any capital gains distributions from that mutual fund while you're holding it, they're always going to be long term. So let's just imagine that we had $5,000 of capital gain distributions, and we not only had a short-term loss carryover, we actually had a long-term loss carryover of $1,000. So now we're going to net all of this together, and we get, let's see, net $1,000 loss, right? So this is negative 15,000. This is this is positive 15,000, and then we're left with a net negative $1,000. So now we're going to combine lines 7 and 15. So we got the negative $1,000, and we got the $19,000 in line 7. So this is a total of $18,000. So if line 16 is a gain, you're going to report this on line 7, and then we'll go to line 17. If this was a loss, then we would skip and go down to line 21 because we would not need to be completing any of the gain worksheets. So we'll walk through those because we have a gain. But in line 21, this is where you're going to calculate the smaller of your capital loss, or $3,000, and then you'll have the capital loss carryover. So since we're reporting a capital gain here, we're going to go down to line 17. Now line 17, if lines 15 and 16 are both gains, then you would need to go to line 18, complete the 28% capital gain worksheet. This is the capital gain worksheet that you complete if there are collectibles. So that would also be reported to you on IRS Form 8949, and there is a separate capital gain, 28% gain worksheet in the form instructions and in the article. And then you would enter that line 7 amount. It would go to line 19. Unrecaptured section 1250 gain really refers to real property that a taxpayer can depreciate over time. So like a rental house, for example. If you decided to sell your Airbnb, you may need to recapture any depreciation from and then pay the appropriate tax on that recapture. So then in line 20, you would answer whether or not both of these are blank. And then you would also indicate whether or not you're filing IRS Form 4952. So that is the form that taxpayers use to claim an investment in interest expense deduction. So if you are completing that, then you would need to go to the Schedule D tax worksheet, and that is in the the Schedule D instructions, simply because it is a very long worksheet and probably would not be appropriate for including in the article that we've written, which already covers a lot of material. If you're not filing IRS Form 4952, then you would need to complete the qualified dividends and capital gains tax worksheet. You can find those in the Form 1040 instructions. So you would not complete lines 21 or 22 below. So a lot of worksheets, and I will over time create videos to go over each of those worksheets, but not in this video. So what we're going to do is we're going to simply go through the rest of the form as our numbers indicate. We're skipping lines 18 through 21, and then we'll go to line 22. So if you have qualified dividends, you would complete the qualified dividends and capital gain tax worksheet and the instructions. If not, then you simply go through the rest of your Form 1040. You've already basically entered the information you need in your Form 1040. Since we did not have gains on both sides, this is being reported on the 1040 as part of our ordinary income, and then it would be subject to ordinary taxes. So that's all we have for Schedule D. It's actually fairly straightforward. There's a lot of work that happens off a page, off of the schedule, in the form of one of the various worksheets that will calculate your taxes based on the asset type that you're holding. So if you want to know more detail about this, we do cover this a little bit more extensively in our article, which you can find either in the link in the show notes or on our website. If you simply go to teachmepersonalfinance.com, type in IRS Schedule D in the search bar, you'll find our article. And you'll also find links to other forms that were mentioned in the show notes as well. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have questions or if there's something you would like me to cover in more depth, please hit us up in the comments section. Thank you very much and have a great day.